Good morning, ladies and gentlemen, and welcome to the fifth session in our second Surety Week, hosted by ICISA. My name is Richard Wulff. I'm the Executive Director of ICISA, and I've got the pleasure to moderate this one. Now, I hope you enjoyed our session so far. For those who joined yesterday's panel on responding to inflation, I hope you agree that we got a different perspective and probably a glimmer of hope on the economic situation. In particular, Mr. Ken Wattred of S&P Global Intelligence, it's their VP of Europe CIS and Insights, he added to my knowledge and my understanding. And if you didn't, you will get a link afterwards where you can review all the items that you might have missed, or show them to your colleagues, the ones you love, your kids, everything. Now, let's turn to this panel on financial guarantee. And we believe that this is more than topical in the current environment. With finance getting tighter and interest rates having gone up and looking to go up more, the corporate world is looking for bigger and better ways, cheaper ways to finance themselves. And financial guarantee might just play a role in this. We've got considerable interest at the moment in this topic, and that's probably the reason why this particular panel has touched a record of registrations in our Surety and Trade Credit Week so far. Now, the topic has a long history in our both credit insurance and surety markets, and you will get an insight from a bit of both elements of surety, but also credit and political risk. And that's the reason why the members of the panel who you see on screen span these lines. Now, just to do an introduction, you see Løgstrup, and Max is head of Tryg Garanti, a specialist entity of the Tryg Group, the largest P&C insurer in Scandinavia. Mats has been in the industry for 35 years, and I must say that when we met each other for the first time, my hair was a lot darker. He has an MBA in strategic planning and finance from CBS Copenhagen, and he is a member of the ICISA Management Committee. And he assures me he is a true believer in the surety industry. Second on screen, you see Felix Winzap, head of credit and surety at AXA XL, a fully owned subsidiary of the AXA Group. Felix has 26 years in the industry and asked me not to say any more because he will say things for himself. So that's good. And third, you see Julian Spiegel. Julian leads the credit, surety, and political risk reinsurance operation at Navigators, a brand of the Hartford. Julian joined Navigators in 2019 with 10 years experience in the financial industry. So before joining Navigators, Julian held actuarial and underwriting positions in the credit and surety section of Munich Re in Munich and Princeton, New Jersey. Julian holds chairs of the Single Risk Committee of the ICISA Credit Insurance Association and a master's degree in mathematics, and there's more, a master's degree in economics. So you are familiar with the panel, and I would like to hand over to the first panel member to give you a presentation. Mats, the floor is yours, please.
Super, Richard. Thank you. And thank you for inviting me to this panel. It's an honor. Also, thank you for allowing me a trip down memory lane. I am to speak about the lesson on financial guarantees from Scandinavia. I think it's fair to you in the audience to sort of do the disclaimer already now. That was not a nice lesson. It was many years back, but some of the experiences still have put traces in the way the surety industry works. Anyway, I will do my best to tell you what I saw in in those days. The Scandinavian financial guarantee has two versions to it. There is the mortgage bonds going back to the early 1980s, and then the financial guarantees that became a big topic in the early 1990s. So with 10 years in between, we saw actually two situations occurring in the Scandinavian market that was quite difficult for all involved. For me, it's important to say when I'm talking about financial guarantees, I'm very close to the definition that is was used in former times, that a financial guarantee is a guarantee for the repayment of a loan. So a very, very simple obligation on the side of the surety to indemnify if a loan is not serviced. This does not mean that the industry does not have a lot of other good tools that are friendly to the working capital of our clients. So having said that now, I think is important, and tools that are friendly to the working capital of our clients you would find first and foremost in project-related bonds, where you can have assistance from a surety to provide advance payment bonds. But also when you construct a contract, you would typically, with the presence of a surety in that space, be able to make contracts that are slightly more front-loaded when it comes to the payment plans, which is for some of our clients quite important. Nevertheless, I have to go back now to Scandinavia. I have to go back to Scandinavia in the middle of the 1980s, my first day at the job. So just finalized my studies at the CBS, the Copenhagen Business School, starting out, coming to this building in the center of Copenhagen, being received by my new colleagues, assigned to the brand new financial guarantee team, ambitious people with a banking background, clever people who were set up in this surety with the aim of building a financial guarantees portfolio. So this was what happened. We are back in the middle of the 1980s. My nice colleagues took me for a tour of the surety company. We were my team was located on the first floor in Copenhagen. That's the most prominent floor to be sitting in. Has good air, and you don't have to walk that many steps. I was taken up the building to the second floor, and then further up to the third floor. The third floor was a strange place. It was a little bit dark. There were quite many people. There were very little speaking, actually a depressed mode, I would say. And I asked, what's going on here? And they told me, this is the mortgage bond claims department. Okay, I said, so what is mortgage bonds? Mortgage bonds, if we turn the page, was the first chapter of the financial guarantees in Scandinavia. Mortgage bonds were popular in the end of the 70s. They were designed in the way where a private individual would need financing for a private home. He would go to the mortgage institute and have a mortgage for the first 80% of the purchase value of the home, and then the last 20% he would typically go to the private market to have a private mortgage to fund and to finance that bit. And the mortgage bonds were in those days issued in favor of the lenders to those private mortgages. So a lender of money would, with a mortgage bond, have the enhanced credit quality of the surety providing the bond. So this was actually quite important. It led to easier access to funding for those buying homes, and it led to better prices for those mortgages, which was a great benefit and a big success. Until the end of the 70s, we saw a dramatic increase in the interest rate, just like we've seen perhaps in the recent half year. We saw a dramatic increase of the interest rate. It hit 15%, 17% even. And in that environment, two things happened. First of all, the value of the private homes fell. So if you were in the outer 20% of the collateral value, then you would be in difficulties. And also at the same time, with the higher interest rate, we saw higher unemployment. And unemployment, of course, by nature leads to defaults in repayment of loans. So already in the very early 1980s, the mortgage bond disappeared in a cloud of losses to all involved. Going forward to my job on the first floor in the building in the surety company in Copenhagen, I was placed with the financial guarantee team. And what were we doing? Well, we were basically guaranteeing for repayment of bank loans against us having a collateral of some sort. In those days, the typical solution was that a client would have a bank loan with a financial guarantee backing the repayment against us as a surety company having the collateral of the value of the property. That ended in the early 90s. We had a crisis in Scandinavia, a macroeconomic crisis, I would call it. So value of property fell sharply, and it caused tremendous losses to those who were engaged in this business, leading to a discontinuation of the financial guarantee business. If we look at the chart that is on the next page here, you will find this very symbolic and easily understood mark of death around the 1992. Last financial guarantee was issued in the Nordic and Scandinavian market by the traditional issuers around that time, seeing loss ratios exceeding 1,000%. So a big lesson learned. Also from this chart, you can see that the loss ratio was super benign. It was at very low, very satisfactory levels, actually up to and including 1990. Moving on to the next page, what was the outcome of these two scenarios, these two significant negative events? Well, first of all, the whole of the market was affected in a significant way. Some sureties did not survive these crises. They simply ran out of capital and were put in runoff. Some even defaulted. Generally, in the Scandinavian market, there was a very, very poor trust in insurance and surety bonds from insurers. I was sent by my employer to Sweden like 5 years later to investigate, should we do some business in Sweden? And the word was nobody trusts surety insurers in Sweden. So probably you shouldn't at that point. Huge losses. Reinsurers took the brunt of this, but also the primaries, as already mentioned. But reinsurers were really suffering in these two instances, and that led to reinsurance exclusions. So even today, you will find that it's very rare that a surety can provide you with financial guarantees in the of the traditional sort in the Scandinavian market. Finally, it meant for the surety providers that those who did survive returned to what is traditional surety product, which is much closer related to the project of our clients. So issuing bonds that assist our clients with performing under a contract for a specific project. Final slide says basically what I have taken from those experiences, and I'm bringing it to you with the hope that you will take it in, keep it with you as part of an understanding of why you do find skepticism with within certain areas of the surety industry on the financial guarantee part. First of all, we did as insurers not have the right competencies. If you are depending on the law of large numbers, as insurers are, you should know that it doesn't work when you have a biased environment like the property sector. So essentially, the sureties were in those days poorly equipped from a portfolio management perspective and capital planning perspective to deal with this line of business. Secondly, it was very much all eggs in the same basket experiences. So we saw our dependency on property values being extremely high when the claims came in the early 80s. Exactly the same happened in the early 90s when the claims came again, a slightly different variant, but the same basic reasoning. And then finally, also, which is very important for a surety, the business did come to us for the wrong reason. Typically, we should do business. We should assist our clients in meeting their demands because we have something to bring to the table. In the financial guarantees / mortgage bond times, it was slightly different. Those businesses that came to us were typically those that could not be accepted by the banks, who are the true professionals when we are talking about financing. So also here, something that will be in the mind of a surety. Why is the client approaching me for a surety bond? With those words, I would say, Richard, thank you for allowing me to walk down memory lane. I hand back to you.
So much, Mats. I hope memory lane wasn't too painful for you, because as we know, we all wrote pretty big checks in those times, and that's probably not something we want to repeat. Having said that, the financial guarantee product continues to be current, and I would like to give the floor to Felix for his perspective, which is probably a little bit more current than the Scandinavian example. It might be a little bit different, and that adds to our understanding. So Felix, if you would like to turn on your camera, please, and may I ask you to deliver your presentation? Is coming online. You want to press the participate button at the bottom center of your screen. Yeah. Please, Felix, if I can ask you to deliver your presentation.
Sorry, Richard, for the delay. I think it works now. Thank you very much, Richard, for the opportunity. As Mats already said, it's a pleasure to be here with so many participants. I'm talking out of Japan, so it's already a bit later for me in the evening, but the topic is so interesting that I'm totally fresh and interested to present quickly how I see this topic, where we can play and where maybe it is a bit more difficult to play. First of all, I want to start with the definition by ICISA in terms of the exclusion that normally we use in the credit and surety reinsurance treaties as per today. This is basically what Mats referred to, the official definition, and this definition is very often like this, one-to-one, in those reinsurance treaties, which I call more the traditional credit reinsurance or surety reinsurance treaty. So a financial guarantee is in that sense understood as any bond which guarantees a financial obligation in respect of any type of loan, personal loan, leasing facility granted by a bank. So I do not have to read the full definition here, but it's important for me to mention that we have this definition in the industry and that it's very often used, as I said. However, if we exclude reinsurance financial guarantees from these treaties that I mentioned, there is an area in which reinsurers and also traditional reinsurers play, such as, for example, our company, but also all my colleagues that I know from the industry, from the other reinsurers. Namely, we also reinsure political risk insurance. Political risk insurance is a word, an expression that many of us use when we, for example, say we work in credit, surety, and political risk. Now, if we look at political risk, these are insurance companies very much specialized in partnering up with banks. And it's very often single risk transactions. It's often, as in this slide, for private obligors. We will see in the next slide, it can also be offered for public obligors. So single risk transactions, can you maybe go back? So it is single risk transactions. It is longer tenors. It's often or almost always a partnering between an insurance company and a bank, or also an industrial corporate. So often partnering up with a bank, which issues, in fact, a loan, for example, in the area of project finance, also bank-to-bank loans, working capital finance, or asset-based leasing. So specialized political risk insurance companies with very specialized underwriters insuring the banks. And as I said, this can be used for private obligors. And if we go to the next slide, it can also be used for public obligors, where then central governments, ministries of finance, state banks, sub-sovereign municipalities can be the insured risks. Very important here, it's always a risk sharing with the bank. The bank can syndicate a given loan with another bank, or they can buy an insurance coverage from the political risk insurance company. And we, as reinsurers, we are active in this type of business. Logically, we also exclude certain transactions, certain industry sectors, maybe countries. We have to be careful with the sanctions. So we also have those sanctions clauses, but it is a product we largely reinsure. If we go one slide further, this is a typical scheme of risk sharing with banks, where we would look at a whole portfolio of loans this is a possible risk transfer which also exists because banks are facing higher capital requirements. This causes additional costs, and they can reduce this systematic risk by a broader risk distribution. Risk distribution can here happen with other banks, as I said. It can be transactions with the capital market, but it could also be a loan portfolio of a bank being insured by insurance companies and corresponding reinsurers. So risk sharing with banks in terms of looking at the overall portfolio of loans where the bank retains a large portion of those loans and then transferring part of it to the insurance and reinsurance industry, we would call that financial guarantees, but this is something which is doable in my view. If you go to the next slide, this was the bad experience that we had as insurance industry, financial industry in the 2007-2008 global financial crisis. It was the invention of the product of collateralized debt obligations, CDOs, which have become notorious in the global financial crisis and which now are basically no longer issued. This goes very much in the area of which Mats mentioned with the mortgages. It was basically the underlying risk was also mortgages. These mortgages were then packaged by the bank, sliced into several tranches and sold to investors, not only to investors, but also to insurance and reinsurance companies. And as Mats mentioned, once the mortgage market in a given country goes into difficulties, many of those underlying loans and mortgage loans have defaulted, and this has resulted, and we can see that on several even series on Netflix. This has resulted basically in partly this was the reason for the global financial crisis. If we go one slide further, again, risk sharing with asset-backed securities, the collateralized loan obligations, those have grown steadily and are still very, very much placed in the market. And it goes then very much into the direction of what Julian Spiegel will explain to us on also significant risk transfers. Here we have basically CLOs invest in bank loans to firms that are highly indebted, have high debt service costs relative to earnings, and are typically rated below investment grade. Credit insurers have started to look at CLOs by insuring the retention notes or by providing insurance guarantees to subordinated parts of a bank loan portfolio. Again, here it's extremely important that insurance companies have control about the accumulations, and it must always be a risk transfer element within these transactions. Important as well, risk sharing, as we call it in the slide. The bank has to keep large part of such portfolios and insure the other part with, for example, insurance or reinsurance companies. So this is basically what I wanted to outline on financial guarantees as far as I see feasible, where I see it more critical. But in general, if you talk about traditional credit, traditional surety, we have the ICISA definition of the exclusion of financial guarantees. And with this, I would like to give back to Richard.
Thank you so much, Felix. That was a very, very balanced view. And we are getting questions in, but I'd like to keep those questions until after Julian's presentation. And you'll see why, because you'll see a continuum of absolute no's to a much more grayscale, I think that's called, right? So Julian, could I ask you to take the floor and deliver your presentation, please?
Thank you, Richard, and thanks to Mats and Felix for their presentations. So I think we've already heard a couple of key points from those two presentations. Mats, when he told us about the Scandinavian experience, I took note that two of the issues were really the competency of the insurance industry to take those risks, the excellency in understanding those risks, and then also really understanding the reason behind banks approaching the industry with those risks. If it's really anti-selection or if there's a room for mutual profit in those products. And then Felix talking about the political risk industry, or synonyms of this industry are what I refer to in the presentation later, CPRI, so credit political risk industry, or what we refer to in ICISA at the single risk industry. So there's multiple names for the same thing, but especially when you look at the single risk industry, you have a very long and also I want to say a profitable relationship between banks and the industry. In the single risk industry, banks are really the largest buyer of insurance. And when you look at our more broader industry, the credit and surety industry, there's a long tradition of collaborating, of also competing with banks. So I think it's a very close relationship that the financial industry and our industry, that the banking industry and our industry has. And sometimes it has gone wrong and sometimes it has been profitable. So, and what we thought when we prepared this meeting was we take a look at the history. That was mainly, the presentation of Mats. We take a look at what we have today. That was mainly the presentation of Felix. And now we want to take a look at emerging products in our market. We don't know yet at this point, where this will lead, if this will be a significant portion of our market at some point down the road, or if it will just go away again at some point. But one of the products that we see creeping into our market and right now is a product called significant risk transfer. So we think it's a good point in time to spend some time on this, to take a look at it. It is not something which is a big part of our books that we see as a reinsurer, and many of our cedents are not writing it yet. Some of the reinsurers really try to stay away from it at this point, but it is something that is a topic of discussion and that is part of some books. That's where we are at this point. So what is a significant risk transfer transaction? It's for those familiar with reinsurance terms, the structure is really that of an aggregate excess of loss treaty. What does it mean? The bank selects a sub-portfolio of loans, of assets, and then we define a structure which companies can invest in. That's the language of the banks. We as insurance companies would say we provide non-payment protection. Same thing, just two different perspectives on the same thing. And what do we provide protection for? We basically start paying as the insurance provider when the aggregate loss of the underlying loan portfolio exceeds a certain threshold. So what you have here is a structure with multiple layers, and so you usually have an equity tranche, which is the lowest layer, and this equity tranche usually usually covers the expected loss. That's sort of the ballpark of where the equity tranche is, or the first loss tranche. Then on top of the equity tranche, we have the mezzanine tranche, which usually consists of multiple layers itself. And the equity tranche starts sort of around or just above the expected loss, and then goes up and will have its upper limit somewhere where the aggregate loss will exceed it only with a relatively small likelihood, and that likelihood corresponds to an investment grade rating. So we have an equity tranche that starts somewhere in the sub-investment grade and tops out somewhere at the investment grade, and then we have a senior tranche which the aggregate loss will only reach with a very low probability. So not just investment grade, usually the senior tranche is really a very good investment grade rating. The bank usually, and I'm saying usually because this is really idiosyncratic structures, but when the structures that we've seen so far, usually you have the bank taking the entirety of the equity tranche, the first loss tranche. Then you have investors providing cover for the mezzanine tranche. The CPRI market that I've seen so far usually provides cover only for the upper layers of the mezzanine tranche. So that means not right above the expected loss, but let's say the mezzanine tranche consists of 4 layers, then the CPRI market would mainly play in the upper 2 layers of the mezzanine tranche. That means they would choose layers that will be impacted only with a likelihood that corresponds to an investment grade rating. That's usually where the appetite is of the CPRI market. And then usually again, the senior tranche will be held by the bank. Also, there will be often a co-participation on the mezzanine tranche. So even on the mezzanine tranche, the bank will take a portion of the risk. So that's just in a nutshell what the structure usually looks like. And again, it really depends on the individual structure, but that's sort of a common theme what we are seeing. If we could move on to the next slide, please, Richard. So I said the structures are very idiosyncratic. I mean, they're negotiated between professional parties. It's not a plain vanilla product, but what I wanted to stress is it's not happening in a vacuum. It's happening against the backdrop of a regulatory framework. Sorry. So when we saw those SRT transactions, they were always being bought by or issued by European banks. I've only seen them being issued by banks with internal risk-based capital models. So banks that are regulated by the European regulator and that play according to the rules set by the European Banking Authority, the EBA. And the EBA has, in 2017, they've issued a discussion paper on what those SRTs should look like, what are the prerequisites. And there's a couple of things that the bank has to follow in order to set up as an SRT structure. And the reason they're doing this is because they really want to reduce their capital need. So if they are not playing according to those rules, then the regulator will just not accept the SRT as a means of capital relief. And part of those rules are that, for example, you have that the data information provided is also being verified by some third party, and that's usually one of the big four. They are verifying the information and the underlying data. And then when we look at the assets that are being issued as part of those SRTs, it's usually sub-investment grade loans, for the simple reason that if you form a book of investment grade loans, there's just not enough capital relief for the entire thing to work. It's usually something homogeneous, some very specific product that is easily identified, because otherwise communication between the different parties is just too cumbersome, too difficult. And again, it's really something where the bank, for diverse reasons, sees a very clear opportunity to reduce capital. That could, for example, be that the bank is overexposed to a certain industry, to a certain region, to a certain type of product. So it's the intent of buying an SRT is really the capital relief, and not that the specific loan is just a very bad loan. That's the theory, obviously. Good. So if we could move on to the next slide, please. Before this meeting, I sat down, just brainstormed on what are the pros and cons of what we're seeing here emerging into our market. It's not comprehensive. It's really just food for thought. Opportunities are and this is from the perspective of the insurance industry. I mean, it might be exactly the opposite from the perspective of the bank, but for the insurance industry, the opportunity is the bank doesn't choose the asset because it's crap. The bank chooses a portfolio of assets where it sees capital relief opportunities. I would say that's a good thing for us. Diversification, usually those assets are assets that are not being shared with the CPRI industry elsewhere. So it's good for diversification for our books. The CPRI industry usually provides protection for layers that are investment grade, that are at least investment grade. So it's a credit quality that we don't see that often. That's good. Usually the assets are located in politically safe regions like Europe, but also other OECD countries. It's a non-commoditized product. Not only a minority of the CPRI players can play in that market. So the risk weighted premium that you're getting should be superior to the plain vanilla stuff that you're seeing elsewhere. Pricing is based not on the underlying product itself, not on the margin of the underlying product, but on the capital relief that the bank is getting for laying it off. So a lot of those assets that form part of those SRTs are, for example, exposures that come from RCFs. RCFs are products that the bank just basically gives almost for free to its clients as part of an overall relationship, so there's no margin there. And if the insurance industry would take a share of the margin of the RCFs, they would really just be underpaid. So this is something that now, because the bank is actually not considering the underlying margin, but the capital relief, suddenly it becomes something that is sufficiently priced for the industry. It's in a regulated environment. It's not just the bank doing whatever they want. They have to fulfill certain criteria when they place it. You have the involvement of verification agents, especially the Big Four, usually. So it's I think there's some opportunities here. Then there's also some very clear challenges. First of all, when we deal with a bank, we will always only see a very small fraction of the assets of the bank. So we will never be 100% sure that what we are seeing here is the good stuff. The great stuff will always be kept with the bank. So we have to rely on the fact that what the book that is being seeded it doesn't hide something that is really crappy. There's a risk for anti-selection here. It's a new market for CPRI insurers, so we just have less expertise than in other areas, and that was a key factor in what Mats explained to us. Competency, so we don't yet have the competency. There's experience asymmetry. The banks just know a lot more about this than the insurance industry does. There's information asymmetry. The bank has a very close relationship with those creditors that we don't have, so they just know more about this. There's a modeling risk. This is also a key ingredient of why we got it so wrong in the GFC. We just didn't understand the correlation between the assets going into the GFC. And when everything happened at once, we were all very surprised and the losses were huge. So we really need to make sure that we don't underestimate the correlation between the underlying assets, because the correlation can really blow up the aggregate loss. And then we also, that's an ongoing issue always when collaborating with banks. We have a different culture in the insurance industry than in the banking industry. A banking industry is more one-off focused. An insurance industry tries to have a more partnership-driven approach, tries to earn money in the long run. So it's looking through the cycle. And so that makes it a little, so that is definitely a challenge, I would say. Doesn't mean that this is everything, but that's what I came up with in preparation for the meeting. And that's where I would like to leave it at this point and then engage in the discussion with the audience. Thank you.
Well, thank you so much, Julian. Thank you so much, Mats and Felix, for what I think is a very balanced view. It's not a black or white thing. And there are different shades of gray here. And to start with one different shade of gray, and that's a question coming from Jose from Cologne, specifically, I think, to Mats, is, and Mats, if you want to put yourself on screen again, that would be good. The question is the ICISA financial guarantee definition always clear? And specifically, if we talk about payment guarantees, would you see them as financial guarantee? And if not, what distinguishes them? In the absence of Mats, while he's getting on screen, Felix, you might want to share your thoughts on that.
Yes, very quickly. I tried to comment even in this answer. Sorry, the question was merely for Mats, but we see payment bonds, for example, in Mexico. We see them as part of a reinsurance treaty: payment for energy, payment for oil and gas, payment for light energy. So it's not linked to a loan, but it's linked to an underlying trade. So it's like reverse credit. Instead of buying a credit insurance, you buy a payment bond, or you offer a payment bond, and you basically cover the payment of the delivery of a given good. So it's different from the financial guarantees, which guarantee the loan. That's why I'm saying there is a difference, but it's also not, as it's written here, 100% clear. There is not a clear black and white. So over to Mats.
Thank you, Felix. You did very well. I think, yeah, there's always room for interpretation. You have to look at what is the intent behind the transaction, and couple that with the wording of the exclusions, then you will have a pretty clear answer, I would say. But yes, we do have working capital products in our portfolio that are generally accepted in the market, and yes, it can sometimes be a little bit of a challenge to understand what was the financial guarantee and what was the accepted working capital instrument provided. Thank you.
As a great Swiss reinsurer once said, every bond is a performance bond, right? Also a financial guarantee. Now, turning to Julian, you've got a question from Andreas from Zurich, who thinks you had a great presentation. I agree with that. Now, his question is, opportunities and challenges are one-to-one the same as the ones the market faced with the debacle of subprime CDOs. What can we do differently to avoid the same outcome?
So I think there are some difference to different. So first of all, we actually agreed on not promoting significant risk transfer too strongly, especially Felix and I, because we don't want to see too much of this happening. But I think there are differences in what we saw in the GFC and what we're seeing right now. So first of all, it's less. I think there's more diversification right now. It's not just linked to one specific product. What blew up the GFC was really the mortgage, the linked mortgage, and now we're seeing those SRTs covering a whole gamut of industries, regions. So there's just more diversification in the product per se. Now I had another point. What was the question again?
So what can we do differently to avoid the same outcome as in 2008?
Yeah, and I think what the industry has also learned is that, how terribly wrong we got it in our models. Rating agencies just gave those layers great investment grade ratings, and in hindsight, it was understood that the tail scenario, that the unexpected losses, we would call it in the insurance industry, was significantly higher than what we expected it to be. So we really underestimated the correlation between the assets. So I think what the industry has to do, it has to build in a lot more buffers than we did. And I think it, to a certain extent, it also does it, because when you see markets invest in SRTs or provide cover for SRTs, they usually try to pick the upper layers. I've never seen one of our cedants being in those layers that are very close to the equity tranche. So even if they get it wrong, my hope would be that that it will still be sufficiently removed from the risk for it to blow up. So that's and I think that's a very difficult thing when we see cedants approaching us with this new product. I really want them to have a deep, to have as much knowledge as they can have. If somebody does this for the first time, then with an underwriter who has no experience in this market, who doesn't have a banking background, then I would be very skeptical to support this as a reinsurer.
Thank you so much. And we've had a lot of questions and a lot of comments. I'm afraid we're not going to get through them all. But one of the questions came along with a comment of one of the people who's been in this industry for a very long time and who talked about naive underwriting in the Scandinavian financial guarantee episode. And I think that's what you meant, Julian. But what he also asks, and that's a question for all of you.
Sorry to interrupt. I just want to point out that this is not, Mats was not there when the naive underwriting happened.
Absolutely. Very good point.
But might I add here to what Julian is saying, that, well, it was not naive, but it was what Julian said, the difference between banking and insurance by culture. That when you're working as an insurer, you have a tendency to actually have a pure heart and a trustful soul. So you are conducting business in the understanding that you are partnering with your client. And that can be extremely expensive if you get it wrong.
Well, let's stick with that thought, because the question this gentleman from Barbados, I think it is, is, so you don't believe that banks/financial institutions will always be adverse to risk and will try to transfer the poorest part of their risks to the insurance and reinsurance industry, independently of the intellectual complexity of the current deal proposed nowadays? So, Mats, you talk about the insurers as pure at heart. Love that. Would you question, and would you sufficiently question, the motivation of a bank to transfer this?
I do believe that, as Julian and Felix were also pointing out, that there are there are credible reasons for a bank to offload risk. There are certain mechanisms surrounding capital capacity for that sake as well, which means that banks have a natural reason to be in this market. But there is also a need for in the receiving end to understand the transaction and what is going on, and this is actually demanding, as already commented, the knowledge of the bank, of the portfolio, of the share is tremendously higher than on the knowledge in the receiving end, so to speak. But I would perhaps use this opportunity just to move a little bit besides saying we do have one area where we see successful financial guarantees existing today, and this is in the export credit agency, the ECA world. This is actually done successfully by clever people who understand that they are dealing with projects, and it's project finance tools they have to take into place. So it does exist in the market. We do see financial guarantees, but not very much in the private segment.
Would anyone care to add to what Mats has to say? If not,
maybe one quick point. I'm not in property, but when somebody buys a fire insurance, I think there is always reason to believe that maybe this house is particularly prone to the risk of fire. So I think we always, in everything we do, we have an asymmetry of information and knowledge, and this is the same for banks. I think Mats put it very right when he said there's a natural reason for banks to be to collaborate with us, but that doesn't mean that any individual transaction actually makes sense for both parties.
Let's move to a question from Simon from London, one of the premier brokers of our industry. And this is a nice one, and I'd like the reaction from all three of you. Are reinsurers more capable of underwriting SRT transactions than primary insurers?
I would please, if I may start, I would say yes. Reinsurers have the modeling, have the tools to work with portfolios, and I think reinsurers are in that area. And now I hope not too many primaries are listening in, but they are on a higher level of understanding portfolios in my perspective. So I think the answer is yes. But do we with reinsurers see the needed, the required level of understanding of these portfolios? That's a question mark. Yeah.
I think Mats, here it also depends a little bit on which reinsurer we are talking about. We are a reinsurer, ICISA Re, we have 8 people. I think with 8 people, I can impossible structure such a deal with a bank. It's really difficult because we don't have the human resources, we don't have sufficient work power. We like to work together with seeding companies. This is our core business. And if it then comes to the transaction with a bank, it can be possible, but it must be quite plain vanilla, maybe even quota share with a bank. That's what we have done sometimes. But to really go into structuring an SRT with a small team of underwriters, that's extremely difficult. Maybe the large reinsurers, the number 1 or 2 of the industry, which have 40, 50 people working in those departments, there I agree with you, Matt. On the other hand, a smaller fledged organization like ours, I think we are not prepared for that. Sorry.
Yeah, to add to what Mats and Felix have said. So I think I agree with Mats' point that reinsurers have a more natural tendency to look at portfolios. So I think from a technical expertise, we might be able to add value. I think what is important in this, and we've touched on this point a couple of times, is really understanding why the bank is ceding the risk. And we as reinsurers, we don't have the relationship with the bank. And I'm saying the bank, it's actually not even the bank, it's the specific team within the bank, placing the SRT. And the ceding company has a relationship with this specific team, so they understand. They have I think they're better in understanding is the bank offloading something, or do they have a valid reason for buying it. But what I think would be a good fit is actually reinsurers collaborating with insurance companies on this, so that we can basically benefit from the mutual expertises in this kind of transaction.
Which I think is a lovely way to close this panel. If I were to summarize this panel, I would say financial guarantee, full in focus. After a number of experiences that we made in this industry, but the industry is looking to satisfy the legitimate needs of its clients. The question is only how. And if I hear Mats talking what Eric from Barbados calls a naive way of underwriting, I would not call it naive. I would call it very specific, very narrow. Via Felix to Julian, a portfolio-based approach with much more structuring elements and much more research around it. And there was a question on how the big accounting firms are doing research and are publishing research on specific transactions. I think that we are making strides, and I think we need to open our eyes in the industry to satisfy those legitimate needs of our customers. With that, I would really like to thank Mats, Felix, and Julian for sharing their knowledge, their insights, and their opinions today. I would love to thank the audience for tuning in, for watching this. I hope you learned something. I hope you saw something new. And I hope it made you think, which is what we aim to do in the Surety Week. And if we look, for instance, at this afternoon session, 3:00 CET, we are talking about underwriting companies that are financed by private equity. And it's part, basically, of the same issue. With the changing landscape of financing, with interest rates going up, with capital getting scarcer, how do we look at those companies? They might try to finance themselves via SRT structures. They might do all kinds of other things. So I would like to invite you at 3 CET this afternoon to look at this panel and to continue the conversation. With that, signing off from Schiphol in the Netherlands, I'd like to thank you all very much and hope to see you all soon. Thank you.
Thank you.
Thank you.
Thank you.
Bye. Thanks a lot.
Thank you.